there, Podmates. This is Yutaro. Welcome to episode 9 of OrcaPod, a deep dive into DeFi from the builder's perspective. Today, we're going to change it up a little bit, and I'll be hosting the episode instead of Ori. And for this episode, I'm extremely excited to welcome Evgeny, the CEO of Wintermute. So Wintermute is one of the most renowned market makers in crypto. And today we're going to talk about crypto markets, particularly through the lens of concentrated liquidity AMMs, which is essentially the new AMM that we are going to release on Orca. Thank you for coming on, Evgeny. So I really enjoyed, first of all, your interview on the FTX podcast that you did around half a year ago. If you are listening to this episode and you are not too familiar with what Wintermute does, I highly recommend you look it up on the internet and listen to it. It's incredibly good. But for the listeners here today, could you start by introducing yourself a little bit and tell us what you do at Wintermute?
Hey everyone, glad to be here. Basically, in terms of general introduction, Wintermute has been around since 2017. So we started right in the middle of bull run back there. And what we are doing is we are one of the leading market makers in crypto at this stage. The activities that we are doing are widely ranging between providing liquidity on centralized exchanges, decentralized exchanges, OTC. We are doing venture investments as well. So it's basically, really a lot of liquidity provision in either secondary or primary markets. And we've been active on DeFi for quite some time as well. Our first foray into DeFi was in 2019 when we started providing liquidity for Dydx when they launched their spot protocol, and we've been supporting them since then. And in DeFi summer of 2020, we basically participated pretty much from the very beginning as well, with starting with Uniswap, but then SushiSwap, and basically all the other AMMs.
Yeah, so when I first heard about Wintermute, I believe was around 2017, 2019, or 2018, when Wintermute was involved in the ICO phase of crypto. And I'm less familiar with Wintermute's involvement in DeFi, definitely a lot less than I should be. So curious to hear your thoughts on the different dexes that are out there. Broadly speaking, I would say if we were to categorize them, there are the vanilla AMMs, the ones where you provide liquidity along the entire price range. There are also concentrated liquidity AMMs. And then a third category, I would say, would be order book dexes. For example, Dydx, of course, and Serum for the Solana ecosystem. So curious to hear your thoughts on the different type of dexes.
Yeah, I would say on Wintermute side, there are, if I have to count, there are like 4 different types of decentralized protocols we interact with. So Dydx, Serum, so basically order book protocols would be the first one. Then we do trade on AMMs really a lot, primarily as a taker. So we are taking liquidity from them because sometimes it's just basically way more liquid than centralized listings in certain cases. But we also provide liquidity on AMMs for some of the projects that are just launching, and then we are seeding liquidity on the go. We are very active on the RFQ aggregator scene as well, with projects like 1inch, Matcha, or Paraswap. We're basically one of the leading market makers there as well. And finally, that's more recent from last year. We've been providing liquidity to basically vault-like structures like Ribbon or Katana.
One other thing that I've always been kind of curious about is with Wintermute's involvement, and maybe this is true for other similar players in the space like Wintermute, what is the incentive structure for providing liquidity in dexes? Is it similar to providing liquidity on centralized exchanges for altcoins, or is it slightly different? To give context, I suppose, my maybe naive understanding is that market makers like yourself, you either receive or are able to borrow tokens depending on kind of what kind of exposure Wintermute wants, and then provide liquidity. In addition, they can receive additional payouts in some token, whether that be just receiving the token itself or receiving some kind of call option for the token. That's kind of my understanding, but is that broadly how firms like Wintermute participate in DeFi?
Pretty much. I mean, like the ultimate goal for any market maker is to make money one way or another. Like for us, there is an added constraint, I would say, is that we want to do it in a like legit way and not doing anything which we can consider or anyone else can consider market manipulation. But in general, yeah, basically what you mentioned is the way we obtain liquidity in the first place, because we need to be long tokens to, well, show offers on centralized exchanges or provide liquidity on dexes, for example, as well. And with long tail assets, it usually comes in form of market making agreements where we're trying to effectively protect ourselves if there is not enough volume in a particular token, or if it's just like one way move, and then at least we have this call option on top of it to make sure that the whatever losses we have, or like if you don't make enough money on trading, they're still covered by the call option.
Yeah, that's interesting. One thought that I've had before is when LPs provide liquidity, let's say for our product with Aqua Farms, they just receive a token. And so they're either long the token if they don't sell it, or, if they immediately sell it, then they realize profits in some other token. It would be interesting if it was possible for these LPs to instead receive some kind of call option. And, like you mentioned, Katana and other similar protocols are creating these interesting products that have different payout structures. So I'm curious to see how that plays out. But, another thing that I have to ask you about, we're biased here since we ourselves have built a concentrated liquidity AMM, is, what are your thoughts on that? Right now, the main one in production is Uni V3, but has Wintermute provided liquidity for it? Has it market make? Has it traded on it? And what are your thoughts on it?
Our general views about AMMs kind of switched over the years. So like when Uniswap appeared, like I was super skeptical about basically how successful it can be, because market making business in general is very complex. Like you have so many things to worry about. You need to, like, especially on technology side, you need to set up a lot of connections. You need to build models. You need to think about the hedging. Like it's just like really a lot of things to worry about, and two things that you can just squeeze it into a simple like formula sounded quite ridiculous, frankly. Quite obviously, my analysis was not super correct because like if you look at how successful AMMs have become since 2020, yeah, it definitely looks like there is an appetite and there is an interest in those kind of protocols. And I think what's concentrated liquidity AMMs are going towards starts to resemble much more an order book, because it does allow more sophisticated market participants to provide liquidity in a bands where they want to provide it, and also switch this liquidity if the market switches. So I think it's quite an interesting step. We haven't dipped out toes yet and providing liquidity in a concentrated way yet, but it's something we will most likely try sometime later this year.
Yeah. So one thing I've noticed over the years is that it seems like folks who have kind of deep experience in TradFi and understand how order book kind of markets work are generally very skeptical of AMMs. And then, essentially the folks that, just kind of came in from maybe like a more general programming background, they just don't know any better. And they just try it and then they see what happens. And it's interesting to see how in the space you can kind of just almost accidentally come up with something incredibly interesting by essentially, not knowing any better, or not knowing that it's just a terrible idea. I'm curious to hear, you mentioned there are a lot of kind of parameters that have to be set when providing liquidity. Curious to hear, like, what do you think is missing with, even with concentrated liquidity AMMs that you'd love to see on a DEX?
Yeah, so like there are smaller things like being able to set up your own fees, for example. But I think ultimately the main feature that's missing is probably being able to react to change in volatility in the market. And that's basically one of the key things for any market maker with their strategies is if it suddenly becomes really busy, you provide less liquidity and you provide it with much higher spread, for example. And that's something that's theoretically possible, I think, to introduce to AMMs, even to constrain liquidity ones, because there are oracles on all the major chains now. But I think that would be pretty major improvement, because in terms of how to provide liquidity for sophisticated market makers, that would be the first thing that we would build ourselves, basically, to try to quantify the well, we already quantify volatility internally, so we would just plug it into our models, trying to implement it in the same way as we would in order book. And if a concentrated liquidity AMM would introduce it by themselves, I think it's not like it would make our life easier, because I think we would do it ourselves still. But I think you would attract more liquidity from less sophisticated, well, I wouldn't say market makers, but more like liquidity providers, because then they would also feel safer to provide this liquidity in volatile times, when it's actually the scariest time to do so.
Right. Yeah, I hear you. Right now it's not possible to dynamically set fees. And, although you can pull liquidity, which will effectively increase spreads, you can't directly increase spreads, or you can't directly set what the spread will be. My general sense, just coming at this from a computer science perspective, is, a lot of the reasons why like any kind of AMM is designed the way it is, for computational efficiency. And the more you want to customize things for each individual LP, the more computationally complex it gets. But, it is always possible that some gigabrain comes up with a way to provide LPs even more control. So I think that's something that could be interesting in the future as a development. One other question I had was, maybe this isn't possible in the general pools, but maybe it is possible to have, let's say, like permission pools on something like a concentrated liquidity AMM, where only Wintermute can provide liquidity. And that may allow a firm like Wintermute to have more like adjustable configurations. Because if Wintermute is the only one that provides liquidity in a certain pool, then it would be possible to adjust fees. Is that something that, a firm like yours might find interesting?
I would say the main use for Wintermute specific pool would be, I think it would be primarily on like KYC AML side. If you really want to trade with institutional counterparties and they need to be sure that they always trade against Wintermute, I think that would be the way to do it effectively. But I think in general, another way to kind of solve it would be instead to basically leave it the current system as it is, but basically give a market maker to a possibility to provide liquidity on demand as well. And I think that's what currently can happen in theory as well, at least on the Ethereum mainnet, where if a market maker sees that somebody wants to buy from an AMM, we can programmatically start providing liquidity in the same block and effectively make the price better for somebody who is buying with a large order, for example. And then afterwards in the same block, we can like remove this liquidity, and then so we don't have any exposure afterwards. And I think that's something that can be done on Ethereum. I'm not sure if it can be done on Solana. I guess it can in theory. I think you would be more qualified than me to say that.
Yeah, I think I've heard it called as just-in-time liquidity, what you just described.
Yeah.
And yeah, it is definitely theoretically possible on Solana. And I'm sure, pretty soon we will see folks doing that on Solana mainnet as well. I guess the biggest difference is that since right now there isn't a fee market, you kind of have to do it off-chain. You have to coordinate with the validators off-chain in order to insert a transaction at the beginning of a block and then, remove it, add another instruction or a transaction at the end of the block. It is definitely possible. I think that one is interesting too, because it's fairly controversial. In the case that you described, it's essentially a good thing, right? Because you're just providing more liquidity and you're providing a better price. But it is also possible to do the opposite, which is to pull liquidity before someone's trying to make a trade. And then, I personally think that the market is a market, but there could be a perception that is, bad for the overall market.
Can this be potentially solved on the protocol side, where you can disincentivize people doing it just programmatically? Because it would be the same for us. Like we would like to do the first, but we actually would be quite against even ourselves doing the second, because it's just not. Basically, I guess like our philosophy as Wintermute is like, if a retail person wants to trade, or institutional for that matter, and they think they want to trade at the price, and we can give them a better price, that's great. If we actually give them a worse price, that's just not in line with our values, I would say. So enforcing it on the protocol level would be quite an interesting feature, potentially. because maybe you can do it. Like maybe you can say that, okay, you cannot withdraw liquidity and add it to the same block, for example.
Yeah, definitely. That is something that we considered, but isn't included in the initial version of Whirlpools, which is, like you described, we've kept the ability to change your position within a single block. But it's definitely something that we could change fairly easily. We've decided to take kind of a wait and see approach to see what LPs actually end up doing on mainnet and then adjusting from there.
Yeah, I don't think anyone is that sophisticated yet. That would be my guess, but maybe not. But in future, I think it definitely would be something worth considering.
Yeah, I mean, if there's money to be made, then people will figure out how to do it. So curious to hear your thoughts on, if we can go back a bit, your thoughts on Dydx. I personally think it's incredibly interesting. What Starkware is doing is incredibly interesting. And I've looked at Dydx a little bit and how they work. From your experience, was it fairly similar to providing liquidity to a centralized exchange, or did it still feel fairly different? Did it still feel like a DEX?
I think it's very, very similar to centralized exchange. Like the only thing that's obviously different is the custody side. But from that perspective, it's less secure in a way, because with centralized exchanges, like you can have multiple controls with like 2FAs and what's not, with how you can access it. With market makers, it's basically, if you algorithmically provide liquidity, it's much more difficult to do it, because you still need to store your private keys somewhere, and we do implement a lot of smart ways to make ourselves protected in that regard, but it's still quite a complicated thing to do, because every order you want to send, you need to sign it with your private key. And centralized exchanges are different in that regard, because you have API keys, but those API keys are different from for withdrawals and in certain orders. So yes, if somebody hacks into your API keys, they can potentially wreak some havoc on centralized exchange, but they cannot withdraw your funds. While on Dydx, they can actually do both.
Yeah, I mean, centralized exchanges, best security practices are definitely known. And I think at this point, it's rare for market makers to, provide substantial amounts of money to a brand new centralized exchange. On the other hand, layer twos are a completely different story. And we've seen the amount of security events happening on layer twos.
Yeah, I think like one interesting thing about Dydx in that regard, though, is basically the liquidity pools they have for market makers to tap into, effectively uncollateralized borrowing that they enabled. I think that's one of the best features of the new Dydx in general, because we do utilize it, we do use it. And that kind of solves to a big degree this issue with us being able to withdraw funds, because, basically if somebody hacks into it, it's basically, first of all, it's more difficult to do so, because we need to return the loan. Basically, like if you want to withdraw from accounts which effectively has funds on it, we need to return the loan to the pool first, and then only then we can withdraw the money. So it basically makes the whole system much safer, because we can just trade with the loan funds all the time instead.
I actually didn't know that there was uncollateralized loans on Dydx. That is pretty interesting.
It's only for market makers, so it's only a handful of market makers who can access it. I think it's something like 5 whitelisted market makers at this stage, but the pool is relatively big. It can support 2, 3, 4 times that.
Got it. Another kind of aspect of dexes that I've been thinking about, which you definitely know much more about than I do, is how to make money effectively as a market maker, especially for concentrated liquidity AMMs. So I'm sure that you've already seen or you've heard about the article, I believed, on Rect that was talking about how most LPs on Uniswap v3 is not making any money. But curious to hear your thoughts on maybe stepping out of kind of the CEO of Wintermute role, how you would approach things if you wanted to make money on a concentrated liquidity AMM.
I think it doesn't really matter whether it's concentrated on like standard AMM. I would say the models that I would have used, and that's, I think, the models that have been floating around for a while now, is basically where you have one input, which is, your expected volatility of a certain pair or asset. And on the other hand, like expected volumes that you expect to see in this asset, and basically trying to see whether the fees from providing liquidity will offset the loss from expected loss from move in one or another direction. And you can make it more complex. You can, I don't know, run Monte Carlo simulations, I guess, if you really want to. But I think that's ultimately how I would approach it. And I think what it means is you effectively, as LP in a constrained liquidity pool, you have, negative exposure to volatility. And from that perspective, it should be possible to potentially hedge it by engaging with options markets. And options markets have been on the rise recently. I think we will see more and more, especially on Solana. I think we have Psi options and Zeta, and they're supporting both of them, which should allow to hedge at least the most basic pairs in that regard. And I think it will be quite an interesting development in general because it will add up to this composability of DeFi.
Right. Yeah. I'm also personally interested in how the option market will develop. I kind of think of perpetual futures and perpetual options as kind of two big prizes in the DeFi market that it's been partially solved, but not completely solved, especially not in the way that, spot trading for DeFi has been solved. So curious to see how that works out. You mentioned, hedging your position using options. I think that's interesting. Is it possible to hedge your position through a more normal lending protocol as well?
I guess it's possible. It's more like you obviously can hedge yourself. Like if you want to be long both assets and you don't want to have actually exposure to both assets, like let's say it's, I don't know, Solana USDC pool and you don't want to have exposure to Solana, yes, you can just borrow it from the borrowing protocol and then you don't have exposure to Solana, you just have exposure to, effectively trading fees minus the volatility loss. Loss on the move if the volatility is really big. So yeah, that can solve it. Like you can also use perpetuals, I guess, to achieve similar result. The challenge is you still need to rebalance it continuously because it basically means that if Solana doubles in price, you actually have you basically become short Solana effectively because you need to you have less Solana that you borrowed. So from that perspective, like products that we've been looking at quite closely for the past few months was the Squared products, like the Squeeze on Ethereum. And I think those can be quite interesting because they do allow you to effectively hedge that as well. Well, they give you a very similar kind of exposure.
I guess for myself too, I've heard of the Square products, but could you give like a quick summary of what they do?
It's ultimately, it sounds very ridiculous and very simple. It's literally just like if it's a Square Solana product, it's literally Solana Squared. So it's a perpetual, which exactly works like Solana Squared. So if Solana is 100, the perpetual will be 10,000. And so it obviously moves much faster than Solana would. So it gives you sort of leverage, but like what's interesting from the options perspective is like for those familiar with the option price, with the basic option pricing, you manage your risk while looking at your Dydx, and effectively the delta is the first derivative and gamma is the second derivative. And if you look at the Squared perpetual, they actually give you gamma because that's essentially if you take the second derivative of Squared, you have your gamma effectively, which is really interesting. It is on one hand crazy. On the other hand, it's actually very nicely designed in the way to just give you a gamma exposure.
And you're saying that could be used to potentially hedge against any kind of AMM position that you might have as a liquidity provider?
Yeah, pretty much. Like you can try to combine it to get a more balanced exposure effectively. It won't be perfect, but I think it can make up for some much more sophisticated strategies.
Yeah, that's pretty interesting. Some alpha right there. So, just from your perspective, we already talked about the Square products. Could you, share with us a little bit about what else you're excited about in the DeFi space over the next, 12 months?
I would say primarily like anything options related would be really exciting because currently it's primarily like, especially on the Ethereum mainnet, it's primarily just around vaults. So it's just like those auctions that happen once a week, which is a good start because it gives a lot of people exposure to what you can do potentially with options. But I think the more interesting bit is once you can do normal calls and puts, once you can do option strategies like all those like weird names like Condors or whatever. That will be fun. And I think the main challenge with options will be the collateralization primarily for market makers, but also for normal market participants. That's something I'm really curious how it will play out this year, because somebody needs to solve it. Because currently, if you want to sell a call, most protocols will tell you basically to pledge the underlying as a collateral, which is not super capital efficient. Clearly, it makes life of whoever bought this call very easy, because there is no counterparty risk, but it also makes the whole thing much less capital efficient compared to how it is in normal markets. Well, not normal, I would say, traditional markets.
Yeah, options are interesting to me too. It seems like different protocols have come up with different ways to create the risk profile that is similar to options, but not quite the same. People haven't really found any success taking the options product that we see in TradFi and then directly mapping it onto the blockchain. But people have created kind of simplified versions of those. I feel like Vaults is kind of like that. It sounds like these other derivatives, potentially even Square is like that. So I'm curious to see what other crazy thing that may look stupid initially people might come up with that gains traction.
I mean, I would argue that AMMs are actually the first kind of product that gives you option kind of exposure as well. Well, on the short side, nevertheless, but still, yeah.
Yeah, definitely. I definitely agree that at least providing liquidity is kind of, for an AMM, is kind of like a free option. But I guess providing liquidity for a normal order book DEX is kind of like that too.
Yeah, there was this argument that any times that when a market maker posts an order in order book, that's a free option for anyone to take. That's to a degree true. Yeah.
Great. So this has been incredibly educational for me. I've learned a lot, and I hope that our listeners have learned something too. And thank you so much, Evgeny, for getting on the podcast. Is there anything else you kind of want to end this with? Stage is yours.
No, in general, yes. Thanks a lot for inviting me over. I quite enjoyed the conversation as well. In general, quite looking forward to continue interact with Orca. We are already trading on it as Wintermute. In general, we are very keen to experiment with anything innovative. So quite curious how the Whirlpool stuff will play out.
Yeah, we are also incredibly excited about rolling out Whirlpools. Excited to see how people end up using it. And for me personally, I love just seeing the DeFi space evolve and seeing what people come up with. And hopefully we'll be able to continue pushing the boundary when it comes to DeFi. So that's everything from us. Thank you for listening in, and hope everyone has a great day. Thank you.